This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to go through now and look at the world of debt. When we're looking there at debt finance, we first of all need to go through and just look at the different forms of debt finance that exist. So from an exam perspective, we're likely to go through there and see some form of objective test question that we'll go through there and test the knowledge that you have in terms of the different forms of debt and which form of debt would potentially be more suitable for a given scenario within the exam. Now, what we're about to do is, I don't think we're going to introduce anything new or amazingly new within this part of the chapter. So bear with me as we go through it, because most of what we cover now is essentially knowledge that's brought forward from what you've seen in F1 and F2. Okay, the questions themselves just tend to be that little bit more technically challenging, because instead of just looking at the types of debt and the advantages and disadvantages and being able to learn what the advantages and disadvantages are, I personally think you're much more likely to have to use your application skills from the knowledge that you have in terms of specific scenarios within exam style questions. Okay, so what we've got, first thing to go through and look at there is, well, the bank borrowings. Have any of you entered into a personal loan with a bank? I'm sure you have, okay, at some point, whether that's there to borrow some money to buy a new car, whether that's to borrow some money to go through there and build an extension to your house or make improvements to your house and redecorate it. I don't know. You may have been to university and had to take out bank borrowings to fund going to university. Okay, essentially, you will have been involved in some form of bank borrowings, essentially a loan that you will have taken out with the bank. Okay, I think when you've taken out that loan with the bank, you probably found it relatively straightforward. Okay, you haven't had to go through there and provide huge amounts of documentation. It was quite convenient. It was quite easy to go through there and arrange, wasn't it? Okay, and the same applies effectively from a company's perspective as well. It's reasonably straightforward to go through and apply, and you can just apply directly with your bank. Okay, the likelihood is that the company will have a relationship with its banking manager. The banking manager will know the credit worthiness of the business and therefore will be able to grant that credit facility reasonably easily. Okay, however, from the company perspective, when you are looking to go through there and use your bank borrowings as a form of finance, so taking out a loan with a bank, that there's just little considerations that you need to think about there. Is the loan that you take out going to be fixed or variable rate with regards to the level of interest? Clearly, if you expect interest rates to go up in the future, you would be expected to take out a fixed rate loan, wouldn't we? However, if you expect interest rates to fall in the future, you would possibly be more likely to go through there and take out a variable rate loan. Okay. Again, however, you might not be so risk averse. You might be happy to take on board the risk. So again, that needs to be incorporated into your decision. Okay. You might not like variability. You want fixed payments. It's easier to monitor, easier to manage. So even though you think interest rates may fall, you're going to go through it and take out a fixed rate loan. Okay, and again, your predictions about what's going to happen to interest rates may not be correct anyway. Okay, then you've got there taking out a secured or unsecured loan. So the likelihood there is that when you've gone through and taking out a loan personally, it would have been unsecured. Okay, if you couldn't pay the loan, tough. Okay, that the bank would just have to go through there and try and get as much money out of you as possible because you hadn't granted any security over your personal assets. Okay, same from a company perspective. You could take out an unsecured bank loan, okay, whereby the bank would not have any claim on any of your assets at all, okay, unless we went into liquidation, in which case they would, and they would rank in terms of the level of creditors. Okay, but if it is secured, then what we have there is that the loan is secured against specific assets or maybe just your general assets, and therefore if the business cannot pay, then by all means the business is then subject to losing those assets to the bank, so they can then liquidate those assets and then have that cash. From a business perspective, just be aware, secured bank borrowings are usually cheaper, i.e. we pay less interest than unsecured bank borrowings. Why? Yeah, you've got the idea. From a bank's perspective, it's a lot less risk, isn't it, if they have a secured bank loan with a customer. Okay, so therefore less risk. They will therefore charge you less interest. Other things to consider there are looking at the period of maturity. So looking at the length of the loan. Clearly, if you have a bank loan, you want to make sure that not only can you pay off the interest, but maybe also the capital as well. Okay, so what period of time are we going to make that payment? Will it tie into the length of the project? We don't want to do a 5-year project and then take out a 10-year loan. If you've got a 5-year project, then the cash flows dry up after 5 years, and then you've still got 5 years extra to pay off the loan. So just be careful there. And also the currency. If you are thinking of expanding overseas and you want to take out a bank loan to fund an investment overseas, so you're maybe a UK company looking to invest in Europe, or a UK company looking to invest in America, then maybe it might be better if you invest in Europe to take out a euro loan, or a loan denominated in euros. Likewise, if you're investing in America, you might take out a dollar loan. Why? Well, if you're investing in Europe, the income is likely to be in euros, so you can use those euros to pay off the interest. Similarly, if you invest in America, your income will be in dollars, and you can use those dollars to pay off the loan in dollars. And what that then does is that then reduces your foreign currency risk. Okay, effectively there is no foreign currency risk, because you are not translating pounds into euros or pounds into dollars, or vice versa. Okay, so they're just some considerations to bear in mind about bank borrowings, and things that you've probably thought about from a personal perspective as well, if ever you've entered into a loan with the bank. Another form of long-term debt finance, and again, geez, way back there, and is it BA2, I think now, or CO2, what you maybe originally have gone through and studied. So BA2 is the new introduction to financial accounting, whereby in the old days, maybe when you've done it, it was CO2. It's the same, just with a different cover and a different name. Okay, but you were introduced there to preference shares, weren't we? We issued preference shares, debit bank, credit preference share capital. Okay, so we know effectively what a preference share is. It is a promise, isn't it, by a company on receipt of the money from the investor to make fixed payments, whether that's 6 monthly, annually, okay, and then to repay the money borrowed at the end of the maturity period. Okay, key thing is, remember, your preference shares rank somewhere between equity finance and your normal debt finance. It has characteristics, if you like, of shares, but legally, even though it is a share, it tends to be classified there as debt finance, doesn't it? Because there's an obligation to pay cash, so that dividend that we have to pay every single year is the obligation that therefore makes it look in substance like debt finance. Okay. So what you've got there, bits and pieces. I think the first paragraph we've gone through and spoken about where it ranks in terms of between your equity finance and your standard debt finance. Okay, so if you're a preference shareholder, you will get paid before any equity shareholders in case of a liquidation. We're not really worried about liquidation, are we? Okay, it shouldn't be at the forefront of our mind, should it? We're not borrowing money from somebody and thinking about liquidation. We're thinking about borrowing money and investing it and making more money, aren't we? Okay, but that covers that first paragraph. Likewise, key bit there is it, in the second paragraph is that you have, is it that fixed dividend? Remember that fixed dividend is a percentage of the par value, so your coupon rate multiplied by the par value, and therefore it is treated as debt, isn't it? Okay, bits and pieces additionally, just to notice as well, is that dividend can only be paid if there are sufficient distributable profits. Okay, so there has to be enough profits within the business to pay that dividend. If there are not enough profits, then that dividend is lost forever, unless they are cumulative prefs, in which case when the company returns to profitability, those dividends that haven't been paid accumulate, and therefore they will then be paid once the company returns back to profitability. Okay, other bit as well, and again, you just need to be a little bit careful. Usually in most jurisdictions, the dividends are not tax deductible. Okay, whereby interest on debt Other forms of debt: bank loans, convertible debt, debentures, loan stock. The interest that we pay is tax deductible, therefore making it cheaper. Okay. However, here with preference shares, legally, and that's what the tax authorities go with, the legality. Legally, they are shares, and anything related to shares is not tax deductible with regards to the payoff. Okay, so dividends on equity shares are not tax deductible. Dividends on preference shares are not tax deductible either. Okay, excellent. Advantages, disadvantages. Again, this is looking at it from a company perspective, not from an individual's perspective, so from the investor's perspective. But the key bit there is that if you issue preference shares, there is no loss of control. Okay, they don't carry voting rights. You know that from previous studies, don't we? But if you were to offer equity shares, then there could be some form of loss of control. Okay, and then unlike debt, dividends do not have to be paid if there's not enough profit. So if we're tying that into specific scenarios, maybe if you have uncertainty within your project within the earlier years and you're not so sure about the cash inflows that are going to appear, then maybe it might be better to go through there and think about preference shares. Okay, because if you take out just standard debt finance, bank borrowings, debentures, loan stock, you have to pay the interest. Here, the dividends only have to be paid once we become profitable. So if it's a loss-making project initially, then maybe preference shares are the way forward. Okay, excellent. There we go. Disadvantages, not tax allowable. We've mentioned that already, so that makes them a little bit more expensive, doesn't it? Okay. And then what you've got there, you may have to pay a higher rate of interest than what you would just on your standard bank borrowings. Why? Because effectively these preference shares are unsecured. Okay, the only way you get your money back is on repayment, and if the company cannot pay, they can't, or the investor cannot come back and make a claim on your assets unless the company is then liquidated. So it is an unsecured form of debt finance, and if it's unsecured, as we said a few minutes ago, it's a little bit more expensive, isn't it? So there we go. Okay. Debentures, loan stock. Again, I think we all know or are aware of what debentures or loan stock are. You must be. You can't have got all the way to this F3 paper and not realise what debentures or loan stock are. Okay, it's a promise, isn't it, between a company and an investor that the investor will give the company money, and therefore the company will then go through and pay interest to the investor on an annual, semi-annual basis, and also, depending upon the terms, whether it's redeemable or irredeemable, repay the amounts that have been invested. Okay. Again, I don't think there is anything there that's new or stuff that you have not really seen or heard of before. Okay. Again, we know that it is a fixed rate of interest as a percentage. Is it there of the nominal value? We know irredeemable never have to be repaid. Very rare that they exist, but they do in exam questions. Redeemable do exist. Okay. Again, when they are redeemable, it could be either at their nominal value or at a premium on the nominal value. And just remember, when it is at a premium, that means that it is an amount above your par value. Okay, there we go. Likewise, at the start, it talks about secured, unsecured, which is, again, the same as what we had with regards to your bank borrowings. Okay, there we go. I don't think there's anything extra or anything interesting that I can add through there. Okay. The advantages, disadvantages, I think you're probably aware of them again already. Small picky bit, the interest is less than the dividend the company would have to pay to shareholders. So it's usually a little bit cheaper than your preference shares. Again, because they can be secured, and if they are secured, therefore there is less risk, isn't it? Less risk means less of a return, isn't it? Okay. Just note the interest paid is also tax allowable, and therefore that means the cost is cheaper. So will therefore reduce your weighted average cost of capital if you so wish. Okay, and then the dividend. Oh, sorry, the disadvantage there at the bottom. The more debt finance that you take on board, the more interest that you would have to go through there and pay out. If you have to pay out more interest to the debt holders, that then makes it a little bit more risky, doesn't it, from the equity holders' perspective, because the profits that you have then available to pay out as an equity dividend are now less because the debenture interest has consumed all of the profits and the cash from the business. What that then does is that then increases the risk for the business. So even though debt finance is relatively less risky and therefore a lower return, the more and more and more and more and more debt finance we take on board, the more and more and more and more and more and more risky it becomes. And therefore it gets so risky that the equity holders worry, they panic. If there's panic, they want increased returns. If they have increased returns, that will increase the weighted average cost of capital. Oh, and we shall see that all in another lecture, won't we? Okay, when we talk about the weighted average cost of capital, Modigliani and Miller, their theories, and how the change in the level of gearing impacts the value of the business. Okay. Other bits and pieces, again, we may have seen bits of them elsewhere, but quick recap. Deep discount bond or debentures. Okay. Fairly self-explanatory, really. It's a bond that is issued with a deep discount. Okay, what do we mean by a deep discount? At a large discount on the nominal value. Okay, and then they are repayable at par. So why would I, as a company, issue the bonds at such a low value, or a low value compared to the nominal value? Because surely that then means that I get less finance. Okay, I get less money coming in. However, because it's then repayable at par on maturity, you're going to get a huge return, aren't you, as an investor? Okay, because that bond, you are going to receive more money than what you put in, and a considerable amount, given it was issued at such a large or deep discount. So because you're going to get a very high capital return, then what would happen is that you would be prepared to accept a lower rate of interest. Okay, a lower rate of interest from the holder's perspective means then that we as a company don't have to pay out as much until the end of the project. Okay, so again, if most of the cash flows arise towards the end of the project, then this would be a better form of finance, wouldn't it? Okay. Advantages, again, pay low interest, makes it cheaper from an interest perspective in terms of the overall cost. You would need to include, if you like, the discounts and how that impacts the overall cost. And then, as it says at the bottom there, depending on the project, you need to make sure that you have the amount of money on redemption. Maybe that's when you are in a better position at the end of your project that you have invested in. Okay. So what you've got there in a deep discount bond is that it is issued at much, much lower than its par value, and you have lower rates of interest. Don't get that confused with a zero coupon bond, because again, a zero coupon bond is also issued at a large discount, is also redeemed at par, but the key aspect there is that there is no interest at all during the life of the bond. Okay, so who would want to invest in a bond like that? Well, again, the fact that you invest a small amount of money to then receive a larger amount of money on redemption would be quite attractive. Again, this is much more beneficial when you get all of the project inflows at the end of the project. Maybe when you had, was it there, if we go back to look at our deep discounted bonds, remember, you still have to pay interest on your deep discounted bonds. So you have to be making cash flows over the life of the project. Here, with is it there, your zero coupon bonds, if there are no cash flows at all during the project except until the very end, then a zero coupon bond would be much, much more relevant. Okay, so just be aware from a practical perspective. Again, what I go through and do, it's not very exciting, admittedly. I go through and read the study text of your chosen tuition provider, make additional notes on it, note what we've done here. practice the questions, make notes once you practice the questions, and that's the best way to help you learn on this part of the syllabus. Okay, other than that, I will see you in the next lecture. That's bye from me.